understand more about investing into real estate in Germany in this video than the majority of the population here. Hi, my name is Ajay, and in this channel we're going to guide you on how to buy a house here in Germany. Market is highly untransparent. The real estate domain is a very untransparent market. Unlike the stock market, where prices are publicly available and uniform for all investors, real estate transactions here are private and prices can vary widely. This lack of transparency means that real estate prices are not priced in based on market expectations, but allowing for the possibility of negotiating deals that can be significantly below market value. The process of buying and selling real estate is highly personalized here, and it involves direct negotiations between the buyer and the seller. This can lead to opportunities for those who are skilled in negotiating and building relationships to secure prices lower than what might be available in more transparent markets. Success in real estate investing often requires more than just research and analysis behind a computer screen. Building trust and rapport with sellers can take time, but can lead to significant opportunities. I closed a deal once 25% below the asking price in a very competitive seller's market, because I gained the trust of the seller by offering him something he didn't even know he wanted. The ability to buy real estate below market value not only secures immediate equity in the property, but also sets the stage for substantial profits in the future, recurring as well as one-off in 10 years once you sell it. This approach to investing in real estate, focusing on direct negotiations, understanding the unique aspects of the market, and building relationships can lead to building wealth over time. To succeed in real estate investing, it's essential to understand that it operates differently from other markets, that is. It requires willingness to engage directly with the sellers and understanding the market's non-transparent nature and the patience to build relationships that can lead to advantageous deals for you, as well as for the seller. When buying a property, the key factor is determining the future cash flow, especially if you're leveraging, meaning you're borrowing money from the bank. Ultimately, the goal is to generate income, right? For a company, this typically means the profit left at the end of the year, which, when applied to investments, equates to dividends paid out to shareholders. In the context of property investments, this translates into rental income, which becomes available to the investor, which is you. The ratio of this rental income, specifically the annual net cold rent, Netto-Kaltmiete, to the purchase price, Kaufpreis, of the property is referred to as the gross rental yield, Bruttomietrendite. Now, the pressing question is, what is a good gross rental yield? Anything which may give you a positive cash flow would be nice, now or in a couple of years from now. This in turn means that you'd need to cover the mortgage payments. Some investors also take tax benefits into consideration here, making a very holistic view. With the current interest rates, you would at least need to have a gross rental yield of 5%. 4% of interest rate and 1% repayment, plus minus obviously. Of course, the feasibility of achieving this break-even point heavily depends on the interest rate as well as the chosen repayment rate. For those aiming to generate positive cash flow from a property investment from day one, significantly higher returns will be necessary, as you will also have some operating costs which you cannot pass on to the tenant, which is part of the Hausgeld. Location, location, location. The location of a property significantly impacts its potential yield. If you purchase in an area where rents are relatively high and expected to remain stable or increase over the next 10, 20, 30 years, the yield might be comparatively low. Take any German metropolitan as an example. This lower yield reflects the lower risk associated with investing in such a location, because you'll always find a tenant there. Vice versa, if you're investing in an area where the future rental demand is uncertain due to decreasing population, these might offer higher yields in the present. However, this comes with greater future risk, of course. This presents a fundamental dilemma for real estate investors, the decision between risk and return. You'll need to balance future security against the potential return, just like in any other investment. The good news is that this decision can be supported by available data online regarding both future security and return potentials in various locations. Let's take an example. A 5% yield in a city like Duisburg might be considered a poor deal due to the city's economic and demographic factors, which could imply higher risk or lower growth potential. On the other hand, achieving a 5% yield in Munich would be considered a great deal and an excellent return on investment. This discrepancy highlights the importance of location in real estate investments, emphasizing that seemingly standard yield percentage, in this case 5%, can represent very different propositions depending on the local market conditions. So if clients ask me whether a 5% deal is good or bad, my answer is it depends, in this case on location. Leverage. The leverage effect is the one thing that makes real estate investments so profitable. Banks are particularly willing to lend money for real estate purchases because these loans are secured by tangible assets, the properties themselves. This is much more appealing to banks than lending for stock investments or any other financial venture because of the real and tangible value backing the loan. In the worst case, the bank could sell the property which they have collateralized. Here's a simple example to illustrate the leverage effect in real estate investing. Suppose you buy a property for 300K. The ancillary costs like notary, land transfer tax, registration charges and broker are around 30K and will be covered by you. You are borrowing the full purchase price from the bank, which we call 100% finance because of the 100% loan to value ratio. Let's say this property generates a 6% gross rental yield, which translates to 15,000 euros in rental income per year. After deducting interest and other expenses like depreciation, etc., you may be left with 4,500, which you majorly put into reducing the loan you took. Those 4.5K translates into return on invest of 4,500 euros divided by 30,000 to 15% a year, each year. That's your return on invest. You only put in 30K, but you're getting 4,500 back each year. And I'm not even looking at the appreciation of the property, which will obviously happen as well, in most cases at least. And you selling the apartment or house in 10 years would even give you a one-off payment there, which in most cases is tax-free for you. Now, if you're looking for a bank which would give you a competitive loan offer, get in touch with us. You'll find the contact details below. The leverage effect, therefore, magnifies your return on invest by using borrowed funds, making real estate an attractive option for increasing your net worth. Now, some will say that these properties are hard to find. I mean, the 6% ones. That's true. No one is going to present these on a silver or golden platter to you. Sometimes you'll need to do some research. Sometimes you'll need to start building your network. But you'll definitely need to stop analyzing and start doing. When purchasing a rented property in Germany, you step into an existing tenancy agreement. This agreement means you're buying the property with all its rights and duties, including the tenant who may, for instance, be paying a very, very low rent according to you or is causing issues. It's important to recognize that the tenant you inherit today may continue to be problematic in the future as well. Consequently, you may only raise the rent within the legal constraints. However, this situation can also present as an opportunity. Because if everyone else perceives the property as unprofitable due to the existing tenant, but you have a vision for its potential, you could purchase it at a lower price. By renovating or improving the property, you can gradually increase its rental value and overall worth. I closed a deal once with a so-called problem tenant, which was one of my best deals and I still own the apartment to date. I spoke with the tenant upfront and found out that he's about to give notice, which the seller didn't know. She just wanted to get rid of the apartment because of that problem tenant. I could decrease the price because of the problem tenant who was moving out anyways. When you assume the ownership, you also inherit the tenant, including any past payment issues or history. This can influence the purchase price negotiation. In your favor, of course. Therefore, it's essential to professionalize yourself while checking the current rental agreement as well as the tenant. As a real estate investor, you have the power to increase the value of a property by making strategic improvements. Imagine you come across a wrecked apartment. If you possess the knowledge and resources to renovate and refurbish it, you can transform it into an appealing living space, attracting higher paying tenants and a better buyer in 10 years from now. This doesn't mean you need to do the flooring and painting and plumbing and electricity works. You just need to know who can. By expanding living spaces, such as adding a balcony or extending the attic, you not only increase the rental income, but also boost the property's overall value and can achieve a higher selling price in 10 years. These improvements can help resolve issues with existing tenants and make the property more attractive to potential renters and buyers. Real estate investments allows for a multitude of development opportunities. You can explore other rental models such as short-term leases or furnished apartments, and these options can increase the rental income as well as property value. With that said, thanks for watching, and until next time.